Welcome to the deep dive. Today, we're going to get into the EquiTrust MarketSeven Index Annuity. We're using info from Diversified Insurance Brokers for this.
Yes, sorry.
And really, the idea is to kind of unpack how this works, as a retirement tool. We want to look at how it might grow assets, but also protect against market drops.
Exactly. We've got the details here, and the goal is just to pull out what's essential for listeners trying to figure out if something like this fits their needs.
Okay, so first off, it's a 7-year fixed index annuity. Let's maybe break that down a bit.
Sure. So 7-year, that's the main contract term, the surrender period.
Right, and fixed index.
That means the growth potential is tied to market indexes, like the S&P 500, for example. But, and this is key, your principal is protected from market loss. It won't go below zero based on the index performance.
Okay, so protection is built in, and annuity just points to its role in retirement planning, potentially providing income down the road.
Precisely. That principal protection is often the first thing people notice. You're linked to potential market gains, but your initial money isn't directly exposed to the downside of the index itself.
Got it. Now, about that market-linked growth, it's not just one single way it works, is it? The details mention several crediting strategies.
No, there's flexibility there. You can allocate funds based on different indexes. They mentioned the standard S&P 500, but also others like an S&P 500 Dynamic Intraday Index, an S&P MRRC 5% excess return, and a Barclays Focus50. Different flavors, really.
And how the interest gets credited also varies. I see things like point-to-point, monthly averaging.
Yes, several methods. You've got annual or biennial point-to-point that looks at the index change over 1 or 2 years, often with a cap or participation rate limiting the upside.
Right.
Then there's monthly averaging, which smooths things out a bit, or even a trigger method that pays a set rate if the index is just flat or positive.
Okay, so different ways to potentially capture growth. And when that happens, the gains are locked in, usually annually or maybe biennially, and then importantly, it grows tax-deferred.
That tax deferral is a core feature of annuities. You don't pay taxes on the interest earned each year, only when you take withdrawals, which lets the money compound more effectively over time.
And there's some access too, right? It mentions 10% annual penalty-free withdrawals starting from the second year?
Correct. After year 1, you can typically take out up to 10% of your accumulation value each year without incurring surrender charges. Useful for liquidity.
Another point here is switching between strategies. Can you do that?
Yes. Usually on the contract anniversary, you can reallocate your money between the available index strategies if your outlook changes. And you can often add more money, additional premiums, subject to the contract terms.
And the backing. It's EquiTrust's financial strength.
Right. Like any annuity, the guarantees, including the principal protection and credited interest, are backed by the claims-paying ability of the issuing insurance company, EquiTrust in this case.
Makes sense. The surrender charges decline over the 7 years too, which is standard. And there's a mention of a minimum guaranteed contract rate.
Yes, that acts as a baseline safety net, ensuring a minimum return even if the chosen index has performed poorly over the long haul. Plus, there's a guaranteed accumulation value mentioned 107% of the premium after 7 years, adjusting for any withdrawals or rider fees. That provides a predictable minimum outcome at the end of the term.
Okay, let's shift to income. There's an optional income benefit rider, the IBR. Costs extra 1.25% annually.
Yes, it's an optional add-on for generating lifetime income, available if you're 40 or older at issue. That fee is based on the benefit base, which is what's used to calculate your income.
And that benefit base has its own growth potential, something about 7%.
That's a key feature of this rider. The benefit base is stated to grow at a 7% compound rate annually for up to 7 years, or until you start taking income, whichever comes first. Plus, there's a 7% bonus credit to the benefit base based on first-year premiums.
So that 7% growth helps build up the amount your future income will be based on. But it's not the same as the actual cash value you could walk away with, right?
Exactly. It's a separate calculation specifically for determining lifetime income payments. The actual income percentage you get depends on your age when you start withdrawals and whether it's single life or joint life.
What are those percentages like?
The material shows ranges. For single life, it starts at 5.5% at age 60-64, going up to 9.5% at age 80 plus ill. For joint life, it's a bit lower, starting at 4.5% and going up to 8.5%.
And there's an enhancement possible for chronic illness.
Yes, the rider may allow for a higher withdrawal amount if you meet the criteria for a qualifying chronic illness, which could be helpful for long-term care type expenses.
Good to know. What about other protections?
The base contract apparently includes a nursing home waiver and a terminal illness rider at no direct cost. These can allow access to funds without surrender charges under specific health circumstances. And of course, there's the death benefit. Beneficiaries generally receive the full accumulation value.
Okay, so wrapping it up, the Market 7 seems designed as, well, a kind of hybrid solution, trying to accumulate assets with market links, but also provide that safety net, and then offering ways to turn it into income later, plus some built-in health-related waivers.
That sums it up well. It aims to cover both the saving phase and the income phase of retirement, layering in protection against market loss and options for lifetime income security.
So for everyone listening, hopefully that gives you a clearer picture of the EquiTrust Market 7, the protection, the growth potential tied to indexes, the tax deferral, the income options, things to weigh against your own retirement goals.
Which leads to a final thought. When you consider this mix, the potential for market-linked growth combined with that explicit downside protection, how might a tool like this fit into your current retirement strategy? Could it complement what you already have? Or maybe challenge you to rethink certain parts of your approach?